Hi, can everyone hear me?
Yes.
Hi, everyone. Very pleased to be here. I'm actually based in Singapore, and I happen to be visiting London this week, seeing clients, so thank you for the opportunity. I have to apologize in advance that this deck is actually, we're having our AGM this week, so it's quite a lengthy deck, but I will actually be skipping around the slides, so I may not be doing myself favors, but I want to just make it a bit more interesting for everyone here. Just a quick intro. This is an Aberdeen New India Trust listed in the UK. It's managed out of Singapore. We have a team of about 14 people doing research on India. There are 4 of us who look at the India strategies, and we pick the stocks for the portfolio. What I will do is to give, I suppose there will be things that you'll read about in the papers about India and you know, about what's happening with politics and geopolitics and so on, but I thought it would be interesting to give more of a bottom-up flavor, because this is how we invest in our portfolios, and this perhaps could be a good introduction of the way we look at India. So through this, the market for us is very interesting because there are lots of great companies that one can invest in and very interesting themes. And this is what our product has to offer. India has always been known to be, you know, growing populations. You know, there's the demographic dividend, middle class growth, and that continues to be the case. So a theme that we've always liked about India is the consumption story and the aspiration. There's a desire for people to live better, spend better, and that's possible because over time and over many years now, there's been rising affluence with the middle class. But to talk about India in one line doesn't do it favors, because as Unilever in India will always say, they have a win in many India strategy. They can't look at India as one market. So some numbers for you. 10% of the population makes up about 70% of the wealth. So it really shows that it is quite a skewed you know, pyramid here. The middle class is growing and there's elevation upwards, but there's still a big mass market, you know, and even bottom of the income pyramid that still exists in India. But what that really means is that there are companies that are big and still growing. So to just give an example of a company that we recently introduced, maybe 2 examples for consumer companies that we like. We have Hindustan Unilever, that's a subsidiary of Unilever in India, the largest personal product care company in the country, remains the best quality company that we like, you know, for the theme around consumer aspiration. But at the same time, we had recently introduced a company that is the largest branded jewelry company in India, called Titan India. It's the largest, yet it only has a 6% market share and continues to grow because people are able to afford more. They want to actually pay up for quality. And by quality, that really means making sure that the jewelry they buy is authentic. And what's happening in India is, or in the case of India, with the jewelry market, a large part of it is still unorganized, which means that there isn't, you know, one isn't sure whether the jewelry they're buying is authentic. And Titan comes with the reputation of a trusted brand. So those are the businesses that we like in India, you know, has a great market position and a strong brand recognition as well. Moving on to exporting talent, there's a very strong talent pool in India. It's known for being strong in IT, you know, services, but also in healthcare as well. So, and that continues to be a theme that, you know, we have seen through the last 2-3 decades, where, you know, it's not just call centers. You know, they've really moved up the value chain here, helping with companies wanting to digitize, investing in cloud computing. In the realm of healthcare, one of the companies that we have has talked about how, they do research, you know, with big pharma companies wanting to cut costs. They are outsourcing more of their research services. And this company that we have in the portfolio is starting to see a trend towards, you know, trying to diversify their suppliers of research services. It's partly to do with security, but also I think that theme around globally companies wanting to have more alternatives other than perhaps China that has always been an outsourcing partner. So India continues to be a country that benefits from this ongoing trend. Financial inclusion is similar to aspiration. It's a credit-starved country, but because of digitalization, it's given a lot more access to finance, both at the individual level and also for small, medium enterprises. Going green is a relatively recent theme that we've included, and we're starting to see more opportunities here. India remains very fossil fuel dependent, and will continue to be the case as you see GDP growth coming through. There will be a rising demand for energy. But at the same time, they're also investing a lot in renewables. So there are some ways we can get exposure to this structural theme here. Power infrastructure is much needed in India. One of our holdings is actually the national equivalent of the national grid. You can have your sources of renewable energy, but you need to transmit them somewhere. So this is one way that we are getting exposure to the energy transition theme in India. And finally, for building India, the focus has very much been on consumer and services, but what has always been missing has been infrastructure, or at least infrastructure development is, it's still many, there's still a much needed place for investments. So the government has actually been spending a lot more on roads, railway infrastructure, just to address traffic, logistical bottlenecks. And that's something that has been growing more recently because of the government's commitment towards infrastructure development. And I will have a slide later that talks about the longer term opportunities, but increasingly we're starting to see more interest from global companies wanting to, again, diversify their manufacturing footprint, and India actually is very well placed for that. So this is the India that we like and the opportunities that we see. I will just move on to, yes. Perhaps what that means for the stock market, because there has been a lot of positives for India, and that's clearly reflected in the way the market has performed. Compared to the rest of Asia, at least in the last 3 years, we have seen that divergence. India has been very resilient despite key global events, whether it's the Fed tightening, the Russian-Ukraine conflict, and obviously the challenges in China. India has done very well and is actually looking very expensive. So why do we continue to remain positive? We believe that fundamentals are actually supporting the share price performance of the Indian market. On one hand, at the macro level, things are actually very stable. So India's not different in that rates have been increasing, inflation has been rising as well. The difference is that India's actually quite used to this. They're not new to being in a high rate, high inflation environment. So many companies we speak to actually say that it's manageable. More importantly, there's been a lot of improvements at the macro and policy making by the central bank. They've been successful in targeting inflation. And that's, again, with some context, India has gone through its fair share of volatility. In 10 years ago, there was a taper tantrum. So since then, the lesson learned is that it's important for them to shore up reserves. And you see that on the bottom right chart where foreign exchange reserves has increased a lot. And that's helping them also defend or intervene and keep currencies relatively stable. So the macro picture has improved substantially in India. And that's also reflected in the earnings. As you can see, it's actually accelerated towards from 2021 onwards. And returns of equity has been improving. That's what we look at to understand if things are going well for the company and what drives valuations and share price performance. But more importantly, you can see that the red line, debt to equity levels have been falling. So even with lower gearing, or lower debt, returns have been improving. So, I think at the fundamental level, with the macro fundamentals looking very stable despite global external headwinds, with the structural drivers that I've mentioned in terms of the investment themes, this is really why we believe that India is actually a very structurally attractive market to be in. And just some slides here to talk about why we believe the economic recovery that we see today after the pandemic is sustainable. Just quickly going through in a clockwise manner, the housing cycle has been doing very well. And again, this is the context again is that the 2010s has been a very relatively tough period in the domestic market for India. So this is coming off I would say not a recession, but the property market has gone through a 7-8 year downturn. That's picking up. That has started to pick up nicely and continues to be the case. The capex cycle is something I referred to earlier, where it's been driven by. It's always been driven by the housing construction, because there has been a need for housing in India, and the government capex has always been the missing piece. That's also started to change in the last 2 or 3 years. So with both of these two drivers helping overall GDP growth, the reason why we believe this is sustainable going forward is at the bottom, where balance sheets are a lot stronger. I've talked about how the central bank, has been a lot more prudent, has, enough fiscal buffers. Banking system is also a lot healthier today. Similar to the property cycle, and perhaps linked to that, in the 2010 era, there has been its fair share of non-performing loan issues, bad debts in the system. But again, lessons learned. And today we have a much healthier banking system, both at the public sector and the private sector entities. And credit growth is coming back. Asset quality is well under control. Banks are well capitalized. So, and again, at the company level, balance sheets are a lot stronger today as well. So fundamentally, things are actually looking robust in India. And then the last 2 points, which would be, I've talked about how infrastructure is lacking in India, and that is actually changing with the ongoing investments. What the government has done very well is, and also to do with how strong and differentiated the country is when it comes to IT services and its pool of IT engineers. The digital infrastructure has actually been a great game changer for the country. I won't go into too much detail unless you want me to talk about it. But what it's really mean is to bring more companies into the formal economy with the government's reform initiatives that includes the goods and services tax regime. It's also brought more people into the tax bracket. Again, just shoring up the coffers for the government, and it's just fundamentally a lot more resilient today. And this is creating more opportunities, business opportunities for corporate India. Finally, the manufacturing boost, which is again something I've mentioned earlier. All these things, is somewhat well timed because, and it's also a result of the government's earlier reform effort when the BJP first came into, started its first term 10 years ago with all its reform initiatives. It was disruptive at the start, but today we are seeing the benefits come through. And the other initiative has been the product-linked incentive scheme. So there's a big desire for the government to attract more foreign direct investments, localizing manufacturing, and because of how I think globally countries and companies are starting to realize they can't put all the eggs in one basket, many companies are starting to talk about a China plus one strategy. So India will not replace China. China has its strong ecosystem, still has its advantages when it comes to manufacturing. But increasingly, the thought of, outsourcing is that there will be China for China, and they will look at other markets for the rest of the world. So this is an opportunity that India has, and why we think if it's executed well, that will actually be lead to a sustainable growth longer term. But one near-term risk to highlight, which would be that because a lot of because this is the outcome of the BJP government's reform efforts, obviously we want to see policy continuity. And as an emerging market investor, India stands out in that there is a pretty stable politics is actually relatively stable. So in May next year will be the national elections. The risk is that if the BJP doesn't continue its third term, the base case expectation is that they will get re-elected, at worst at a lower margin. The reality is that Modi remains a popular candidate in the country, and the opposition candidates are weak. So this is still something to watch, and might affect markets. And this, again, is the longer-term potential. Because, again, India has always been very dependent on services, on consumption, but one needs manufacturing to create more job opportunities, more job creation, which is an important element or an important factor if you have a population of 1.4 billion. That itself can be a dividend, but it can be a drag if there isn't enough opportunities for everyone. So it was still early days. There's still a lot of things to address within the country, but on the left-hand side, it just shows some of the efforts trying to get around this. There's some progress here. And on the right-hand side, it's where, gives you a sense of where the industries that are benefiting from the production-linked incentives. Electronics is one area where India wants to gain in prominence. And perhaps why one is hearing about Apple launching its first made-in-India smartphones today. So this is an opportunity for India to lose, but so far I think it's moving along in the right direction. Finally, and again I won't go into detail, but this is just to give a sense of how the trust has performed over the long term. And if there are any questions around it, I can take them, and there will be more details on the following 2 slides. But just to say that if you focus on the top line of the NAV returns, these would be the absolute returns. The benchmark is just to give one sense of how we are performing relative to the MSCI India. Our style is such that we are we take a more conservative stance, because whatever we like about India and the growth opportunities, there are risks as well. So the way we protect or think about protecting downside risk is to make sure that we're buying the right stocks, backed by the right people, with strong balance sheets and strong market positions. That may or may not always be appreciated the same way as the markets. So we tend to do better when the markets are tougher, meaning we are more resilient as a portfolio. But when it's a hot market and a liquidity-driven market, we do tend to lag, but our performance, or at least the absolute returns, will still be positive. The last 2 years has been a bit more challenging. Again, if you have read about the ANII group of companies, and I know it's come out in the news and questions about, and this is on the back of the short seller report that talks about all the corruption issues and the question about whether India is investable. We've never invested in Adani, and that's one of the factors why performance has lagged the benchmark in 2022. We've done a lot to try to turn performance around, but one thing we will not do is to change our investment philosophy, which is to buy the right companies that we can trust, and buy companies that not just grow, but we look at how they grow, and we want them to grow sustainably over the long term. So this is just to explain, performance, but really how we think about investing. And I will just stop there. There are many more slides, but I think perhaps that will be, I can use them when there's questions.
Lovely, Kristy, thank you very much indeed. Thank you. Okay. Okay, if you have a question, please raise your hand and wait for Peter or Chris to come over with the microphone. Anyone keen to get started? Otherwise, I will. Okay. Can we talk a bit about the portfolio's exposure to the domestic market? You talked about the domestic consumer. You also talked a little bit about the export. How much of the portfolio is focused on the domestic consumer and the rise of the middle classes, and how much is for the export services and products?
Okay. So India is actually more of a domestic story. The export exposures that the country has and what the trust has would be through the IT services, because these are companies that are Indian companies, but their clients are global. And the US market's a big market for them. So IT services is where one would get export exposure. And to a small extent, healthcare as well. I mentioned the contract research company, and that's an example of a more export business. But this is a predominantly domestic-oriented trust.
And do you have, in terms of your investable universe, kind of a minimum-sized company? Do you focus on larger companies? Where do you spend most of your time?
Okay. So on the right-hand side, you have the market cap split. So it is this portfolio still has more of a bias towards larger companies. The larger companies, we're actually market cap agnostic. We just want to buy the best businesses. And for certain industries, we do find that size matters. So about more than 70% of the portfolio is in large caps, which is defined as more than 10 billion. We do have small and mid cap companies. That is in the range of 28% today.
Okay.
Yeah.
Question here, please, Peter. We'll come to you next.
Thank you for a very good presentation. I've been overweight in India for some years, and I have not bought your fund, it would be fair to say. I wonder if you could comment slightly more on the relative position. I'm thinking, for example, that in 5 years with Stewart Investors, I've made 75%. If I had been with a shocker for the whole of that time, I would have made 128. I am with another outperformer, which escapes me just at the moment anyway. Some have been more volatile, it would be true to say, especially ICG. But you say you're not going to change your investment strategy, but the strategy looking at 5 years, 3 years, 1 year, and indeed recently, seems to be lagging your competitors and would probably place you in the bottom quartile.
Yeah.
If you're in the bottom quartile fairly consistently, do you think that should be inspiring a review of the investment strategy rather than a retention of it?
Yeah. No, thank you for asking the question. So what we will not change is that philosophy. But what we have changed and have looked to, have done to address the underperformance has actually been to improve the way we size our positions and our positioning. So we have made some changes because we recognize that obviously the underperformance cannot just be blamed on the things that we don't hold, like the ANII group. So that's where we have tried to be more dynamic with the way we position our portfolio. So our peer group, the ones that have had more small mid-cap exposure, so Ashoka, ICG of late has done very well. That's also an area that we have been increasing our exposure to. And that certainly has helped, turn the recent numbers around. Our numbers have improved this year. And that's because we have expressed more conviction in the small mid-cap names that are also backed by the themes that we like. But this year, we have seen a bit of a lag with the large cap laggards, or at least the banks. That's one example. But at this point, we actually, if there's any froth in the market, we do see that with the small mid-cap names. We are a bit more cautious of how much this segment has run. And I think if there were to be any correction or pullback in India, that would be more prone to profit taking. So we're sticking with our positions of large caps, but we have a pipeline of stocks that we have identified with our buying price targets to enter when that volatility happens. So I think just to say that we have changed and have made changes to our positioning to address the underperformance. That's paying off. But what we will not change is just the kind of companies that we have avoided. We will continue to avoid if there's nothing that has changed around governance and balance sheet management. I hope that answers your question.
Question here, please. Yep.
Can you tell me, please, what is the base currency of the fund, and if you do any hedging?
Okay, the fund is in sterling, pounds. It's obviously rupees, but we don't do any hedging because that's actually not what our expertise are in. And if we start to try to be clever about currency management, I think that might not always go the right way. So the way we think about currency and protecting the trust from any volatility is just to make sure that our companies have strong balance sheets themselves, don't have any mismatches within their balance sheet. And that's how we've always approached currency exposures within our various portfolios and managed by the team. Yeah.
Any other questions? Gentleman here, yep.
You don't pay a dividend currently. Is this purely by choice, or are there fiscal reasons why it's inappropriate for Indian investment trusts not to pay dividends? Because I have another one that doesn't pay a dividend.
Yeah, India happens to be, India needs more capital to grow, and it's a growth market. So dividend yields for Indian stocks tend to be low. And one really makes money in India from capital appreciation. We do have certain areas in the portfolio that pays out more dividends than others. So IT services is one example, because it is a cash generative business, it's profitable. And they tend to do buybacks actually because it's more tax efficient. That's one example. Power Grid is the other one that uniquely has a 6% dividend yield that's considered quite high in India. When we bought it for the portfolio, it was a single-digit price-to-earnings multiple, 6% yield. Has that growth coming from more renewable energy capacity and the need for grid transmission. So that for us was something interesting to have added in the portfolio. Yeah, but overall, dividends will remain low.
Question at the back, please, Chris. Gentleman to your left with the... Thank you.
Hi, how much of the percentage of the portfolio is in IT and software-related stuff? And what's the sort of performance of that as against the rest of the portfolio?
Yeah, okay. So over here we have the relative sector position, so that's relative to the benchmark. And at the moment we are underweight the benchmark. In absolute terms, it's less than 20% in the portfolio would be IT services. And IT services would really be the offshoring companies rather than the IT companies that one would know, in the US or, there isn't an equivalent of a Microsoft or an NVIDIA type or TSMC. So these are really the IT outsourcing companies. Yeah. So less than 20%. Yeah. Performance. Performance has been good for IT services in the long run. It's been good up to this year. Because of the slowdown and uncertainties around the US market, which is also why we have cut our positions, and it's an underweight today. It used to be a bigger position before. Yeah.
I had a couple of quick questions, if I may. The first is about, I guess, the culture in India for capital markets and the pipeline for new IPOs. Obviously, India is also known for a lot of family companies. And here in the UK, we see a dearth of new issues. And what's the landscape and the outlook like in India for IPOs, and I guess larger IPOs? And then secondly, you talked before about looking at some new companies. How do you generate a new idea? Do you go out and visit the management?
Yeah.
How does that process work for you?
Okay. IPO market is pretty vibrant at the moment, and it tends to be when the market's doing very well. So we're certainly seeing a lot of listings coming up. That was also the case about 2 years ago. So it's a very vibrant space. And actually, we think that it's very good for capital markets because in the past, India really looked a lot more old economy. Now you have the new age or new economy businesses coming for listings, which actually gives us a even broader range of companies to consider, to invest in. Your second question
and
is
how do you generate
idea
an idea
generation.
for the fund?
Yeah. So we are based in Singapore, but we make regular trips to India, on a quarterly basis at least, and we have a lot of companies that come to Singapore. In fact, Singapore is actually a big, there are a lot of non-resident Indians who are based in Singapore, so there are a lot of companies that would make Singapore their first stop if they were to go offshore. So we have to meet our companies before we put our first dollar in. We do our due diligence before we actually make our first initiation. So that would include doing channel checks, speaking to experts if that is necessary. Our process is such that we have to go through the financials, write a stock note, do our own internal peer review. But in terms of idea generation, because we have 14 people, each of them would cover, all the sectors in India are well covered by every analyst. So there is an oversight for every single sector, which means that we leave no stone unturned. Which is also why Power Grid was an idea that came up for us because the utilities analyst did some work, liked the whole energy transition theme, found an opportunity there. He did his homework, he spoke to the company, spoke to the regulators because it's a regulated utility, comfortable with the regulatory framework. So all these are the things that we, as part of our due diligence, and because of valuations, it made sense for us to include it in the portfolio. So that's just one example of how we make sure that we cover the market well.
Okay, thank you. I think it says 1 minute, but I think we're probably just about out of time there. I don't have time for another 4 questions. So, Kristy, thank you very much for joining us. Thank you.